Good afternoon, everybody. This is Tasos Aslidis, CFO of EuroDry Limited, and this is the company presentation of EuroDry. Let me start first by thanking both Fratt and Noble for organizing and inviting us to participate in the Noble conference. And with that, let me start the presentation of EuroDry. I'll direct your attention for a moment in the forward-looking statement, since we're going to talk today a little bit about the future. And after that, I will start the presentation. EuroDry is a company operating in the dry bulk ocean transportation sector. We're an owner and operator of ocean-going vessels that transport major bulk commodities, that is iron ore, coal, grain, and minor bulk commodities, typically referred to as steel products, bauxite, alumina, fertilizers, and the like. EuroDry is in the market, is trading on NASDAQ since May 2018, and it has been created through a spin-off from our former parent, EuroDry Limited. Our former parent, EuroDry, was formed by industry veterans in 2005, one of the oldest shipping families in Greece, the Tasos family, which has owned and operated vessels for the last 150 years, since 1870. This is the fourth generation of the Tasos family in shipping, and this generation accessed the capital markets in 2005, and EuroDry was listed on NASDAQ first in January 2007. Managed over the last 15 years to navigate some of the most difficult periods of shipping, especially after the financial crisis. There have been 12 years that both sectors, the dry bulk and other sectors, experienced very difficult periods. EuroDry's vessels are managed through EuroBulk Limited and EuroBulk Far East, which are affiliate companies of the group. EuroBulk was founded in 1995 and EuroBulk Far East in 2015, and are very well respected and established managers in the sector. This slide shows graphically the evolution of our company and our former parent EuroDry all the way back to the beginnings of the involvement of the fourth generation of the Tasos family. Back in the 90s, we started by being involved in bulkers. Then in 2000, we moved into the container ships. As I mentioned earlier, we accessed the public markets in 2005 and 2007 initially with a private placement, and in 2007 with a series of follow-on offerings listed on NASDAQ. We raised in excess of 250 million to support our fleet expansion. In 2010, we were one of the first companies to make an agreement with private equity to invest in shipping, and we believe that agreement became a template for other investors to participate in the industry. In 2014, there was a new round of fundraising, and an effort started to renew and expand our fleet, as part of which a number of new buildings, another first for the group, were placed, and 3 of those new buildings were vessels that eventually ended up in EuroDry. Finally, in 2018, in May 2018, EuroDry was spun off as an independent company listed on NASDAQ to pursue its own path as a focused pure play in the dry bulk sector. This slide here shows the current fleet of EuroDry. We own 7 vessels with an average age of about 12 to 13 years, having a carrying capacity of 529,000 deadweight tons. Those vessels are concentrated in the middle sector of the size spectrum of dry bulk fleets, which we believe is the segment that gives the most flexibility in terms of cargoes carried, and also realizes the economies of scale and the higher rates that larger vessels command. In our fleet, you can find two Kamsarmax vessels, the Ekaterini and Xenia, that were built in 2016 and 2018. Those are of the vessels that we built ourselves and supervised the construction ourselves. Each one has 82,000 deadweight tons of capacity. Our fleet also includes an Ultramax carrier, a 500,000 deadweight ton vessel that was built in 2017, and also includes 4 Panamax bulkers, Japanese built, around 75,000 deadweight ton each. Those units are a bit older. 2 of them are built in 2000 and 2 of them are built in 2004. In this slide, we describe how the current fleet of EuroDry is employed. As you can see on this slide, 5 of our vessels are in longer term charter arrangements. However, these arrangements are on index-based rates. That is, the rate that our vessels earn depends on the rate on the market. The 2 other vessels, the 2 older of our vessels actually, Tasos and Pantelis, are chartered on fixed-rate contracts, short-term fixed-rate contracts, which are the current ones are to expire sometime this month and will be renewed. That type of employment strategy, we believe, is the most appropriate at this point in the market cycle, because we believe that the markets are on an upward path, and having the flexibility to enjoy the uprun of rates would be very beneficial to our bottom line. If you look at this slide, we try to give an assessment of how that benefit of being exposed to the market translates to the bottom line. We have in 2021, for example, about 1,750 vessel days available to be chartered at market rates. If market rates increase about $1,000 per day, that translates to $1.75 million, which translates to about 74 cents per share at incremental earnings, or incremental losses, I guess, if the market moves the other way around. But we believe we are on a point that it's much more likely for the markets to improve. That's why we have positioned our fleet to have exposure to the developments in the marketplace. On a similar note, if the value of our vessels increases by about $1 million each, there will be a $7 million increase on the value of the company, which translates to about $3 per share. Let me move to the next slide and elaborate more on the last point, and perhaps give you a snapshot, a cross-section of our balance sheet as it is expected to be at the end of December of 2020. As of the end of December, we had bank debt of about $51 million. We had preferred equity of about $16.6 million, and this is the preferred equity that we raised back in 2014 as part of Eurosys, which and part of it flowed down to EuroDry. We expect to have cash and other net assets of about $3 million, and market value of our vessels based on some internal estimation of around $86 million. I can tell you that already that value seems low, as the markets have improved significantly during January. In any event, using that valuation, we estimate our net asset value to be around $21 million, which translates to about $9 per share. As of last week, and even today, our share is trading at around $6.3, which translates to trading at about 30% discount to the net asset value of the company. As I showed in the previous slide, a $1 million increase in the value of each vessel would result in about $3 increase in the NAV of the company. That is at about 33% increase to the net asset value per share. So an 8% increase, this is how beneficial is to the bottom line, both in terms of the earnings and in terms of the valuation of an increase in the market. If rates increase by $1,000, which is very well within the fluctuation of rates and the potential the rates has, and if values increase by 1 million, we would see significant increases both in terms of earnings and the value of the company. Let me now, before moving to describe a little bit about the market, let's give you a couple of words about the management of the company. Aristides Pittas is our Chief Executive Officer and President since inception, definitely of EuroDry, but also of Eurosys. I'm the Chief Financial Officer, and Simos Pariaros, our Chief Administrative Officer. We all have been with the companies and with the group for a good part of the last 15 years or more. Our board of directors consists of people with shipping experience and also experience in the investing and in the banking sector. And altogether they provide us for the right guidance and sounding board to make the right decisions and navigate the shipping industry. Let me now spend the next 5 minutes or so to provide you with a little bit overview of the dry bulk markets and the sectors we operate. In this slide, you can see the recent developments of the dry bulk markets. In the bottom part, how the spot rates of the market, expressed in the form of some Baltic indices, have fluctuated over the last 3 years. The markets had a very bad, an all-time low year in 2016, is not shown on the chart here, and have recovered since. So by 2018, they were back at levels that were supporting, they were supportive of the cash flow and providing earnings. In 2019, we had in the beginning of the year some weakness, which was reversed in the latter part of the year. But as 2019 expired and ended, then the pandemic took center stage in the world affairs, economic and other, and led to first half of 2020 that was pretty depressed in terms of rates that our vessels earned. By the early part of the summer, as China stepped out of the pandemic first amongst the various economies, dry bulk trade recovered and rates improved and retained by and large the levels throughout the end of last year, and January started relatively strong with rates rebounding significantly and reaching levels that provide definitely positive cash flows and earnings for the companies and ourselves. The dry bulk trade, which consists, as I mentioned earlier, of the major bulk commodities, iron ore, shown here in blue, coal trade in light blue, minor bulk trade, which is the dark green, and the grain trade, which is the light green. On average, over the last year, has been growing by about 3% a year. That rate of growth depends a lot on the underlying economic growth of the world economies. And as you will see on the next slide, here we make a rough correlation of the world economic growth with the dry bulk trade. And what the part of dry bulk trade that is more relevant to shipping demand is in ton miles, that is taking into account the distance over which the ships travel to move the underlying commodities. You can see that they moved roughly in parallel. In 2020, the world economies experienced one of the most negative years in terms of economic growth, and similarly, dry bulk trade declined by more than 2.2% in terms of ton miles. The data comes from IMF and Clarkson. Those analysts expect that 2021, the world economy will rebound, and the dry bulk trade will follow suit. We expect to see a 4.4 increase in the dry bulk trade. Looking together in 2020, 2020 and 2021, in terms of the dry bulk trade, we can say that taken together over those 2-year period, we lost a year of growth. So the pandemic set us back by about a year in terms of growth. Another point that I would like to make, of the many one can make in the dry bulk sector, is for the supply side. This chart here shows the potential of the fleet to grow over the next couple of years. It shows the contracted capacity to be built as a percent of the existing capacity of the fleet. That ratio stands at about 6%, 6.1% according to Clarkson's, and it is the lowest, I dare to say, ever. I have been involved in the industry for the last 30 years in various capacities. I don't think I have seen that ratio as low. That means that the supply pressure, the growth of the fleet over the next 2 to 3 years would be minimal. It takes about 2 years for the order book to be delivered. So we expect comparatively less growth of fleet, new deliveries in 2020 and even in 2021, and even less in 2022. We're trying to make an attempt here to put together the supply and demand trends in order to get a feeling and assess of where the industry is going in terms of rates and prices. And this slide summarizes the information that I showed you in the previous 2 slides. I think on the top part, again, it repeats the information about the demand growth of 4.4% expected for 2021. Again, these are estimates that as data is coming in from for the actual for 2020 and developments during January might be changed, but by and large, everybody expects that there will be a rebound in dry bulk trade in 2021. On the fleet growth side, the fleet will change not only by the deliveries, but also will change by the removals. Certain ships will be removed from the fleet. If one makes that analysis and takes into account the vessels that will be removed, the fleet is expected to grow in 2021 by less than 2%, and you can see that that results in a positive balance of demand over supply of more than 2%. That should be a significant surplus of demand over supply to support existing rate levels, and even more than that, lead them to higher levels as well. There are a number of reasons that can support this even further, especially from the supply side. The reason that the order book is such low, it is due to a number of factors taking place in the industry. The majority of them having to do with the uncertainty about the appropriate type of ship to build that will be compliant with the various regulations over the next decade or so. We are faced with new regulations regarding emissions, sulfur emissions that kicked in this year and last year, I mean, and CO2 emissions that put into question whether the existing models, engine models and ship designs would be the ones that would economically comply with the new regulations. Thus, ship owners have been reluctant to invest, to contract new ships, and that has worked in favor of this balance that we discussed earlier. For example, in 2020, there was this low sulfur emission regulations that came into effect. To comply with those, one had to either burn a more expensive fuel or invest in putting some scrubbers, emission cleaning equipment. And that was a key decision for 2020 that indeed led to some ship removals and fewer orders. EuroDry elected to burn the more expensive low sulfur fuel, and has been proven right so far, because at least in 2020 the pandemic reduced significantly the price differential between the fuels, and we were able to justify the decision that we took. So all in all, I think we expect to see minimal supply pressures going forward, and thus the whole investment story about the dry bulk market lies on what one believes on the demand side, whether the trade will continue growing at the rate indicated here. And there are various factors on the trade as well. I mean, we talked about the correlation of the trade to the overall economic growth, but there are more localized factors, for example, having to do with the availability of cargo to move. There was in 2019 an accident in a Brazilian mine, iron ore mine, which restricted the capacity of Brazil to export iron ore. There was a more recent accident earlier this year too. There are trade tensions between Australia and China that lead to dislocation in supplying the coal to China, which could lead to longer hauls for the cargo to be transported, and as a result, more ton miles, which is beneficial for the shipping for the shipping industry. So all of this taken together could create uncertainty on the demand side. But all of this is supported by a very healthy and very supportive supply side, which is half of the equation. And we believe, and we're very confident that the industry will show significant improvement in 2021. So in concluding my remarks here, before I open the floor for questions, why one should invest in EuroDry? It's a small company, I have to admit, compared to its peers, but it is a pure play. It is focused on the middle of ranges on the dry bulk, the middle sizes of the dry bulk sector, from Supramax to Kamsarmax. As I said earlier, that maintains cargo diversification and benefits from economies of scale in transporting the good. I mean, a Kamsarmax is a more effective way of transporting cargoes than a smaller Panamax, and the Supramax and Ultramax is a better way of transporting cargo than handy-size vessels. There are compelling sector fundamentals. I said many times the order book and the support from this fleet growth. The company has a seasoned management team with a lot of experience, both on the management and on the board. And our sponsor, the Peters family, has a significant stake on the company. So if someone invests in EuroDry, it co-invests with people who care to make money on the investment as well. It is priced well below its intrinsic value. As I mentioned today, we're priced at 70% of the intrinsic value of the company, and the value of the company is expected to increase if the market recovers, so there could be double gains for our investors. I believe all of this creates sufficient reasons for one to look at EuroDry, and in addition, being a smaller company in the public sector could serve very well as a platform to consolidate, a public platform to consolidate other fleets that are looking a public exit option, other investors that ended up in shipping and they got trapped into it over the last decade. Companies like EuroDry and its public platform provide interesting opportunities to increase their options to exit. And with that, I will open the floor for questions, if there are any.
Great, Tasos. Thank you so much for a comprehensive presentation. My name is Fratt, and I cover EuroDry for Noble Capital Markets. While we poll for questions from the field or from the viewership, Tasos, which you can do if you're viewing the presentation. Click on the bubble on the lower right-hand screen so that you can submit a question. In the meantime, Tasos, I just wanted to ask a couple questions, more clarification ones. You talked about the net asset value and the impact that you've seen. You were talking about net asset value through the end of the year. Am I correct in looking at, one of the pages and seeing that rates have moved up from, if the Kamsarmax from roughly an average of 12,500 in the fourth quarter to 14,000, and then the other sectors have moved up from averages of the fourth quarter of 2020 of about 11,500 to, respectively 13,500 and then 12,700. Is that roughly correct?
I think you are correct. I think the year have started quite well if you have for an owner. We have seen significant increases in the marketplace, and we've seen that not only in rates, but we've seen increased interest in people looking for ships to acquire.
And do you think there's been an impact on your net asset value or secondhand values? And would you say it's commensurate with the move in rates, or, a little bit lower, a little bit higher? If you can give me a flavor for that, that'd be helpful.
I think we have seen the market strengthening because we're looking to potentially acquire a couple of ships, and we have seen both other owners to demand at least 5 or 10% higher prices over the course of the last 3 weeks. And I don't know of whether any transactions have taken place to register those increases. But we've seen thus, and we expect to see price increases that are reflecting the improvement in the rate environment.
Okay. And I think you sort of walked us through your operating leverage, and that you have very high operating leverage, good exposure to the upward bias in rates. Did I read it correctly, Tasos, that you have about 2% of your fleet that's locked on fixed rates for the year?
We have a very minimal part of our fleet locked for fixed rate at this point. Only our 2 elder ships, Pantelis and Tasos, are on fixed rate contracts up until later this month. The remaining of the fleet are in contracts that are the rate of which is linked to the market indices.
And as rates move up, Tasos, what do you think about how to lock in higher rates? Is it possible? And then at what levels do you, if you can give us a sort of an idea of where you look to lock in rates, that'd be helpful.
I think that's definitely a consideration. It is a decision that it will be taken as the market develops, and the level at which we might lock rate might be revised as we see the market developing. But I would say that if we see Kamsarmax rates, for example, of the order of 15,000 plus, we might be tempted to lock in rates for a year or more, depending on the rest of the circumstances in the market.
Okay. And then on the financing side, do you have much work to do on 2021? And are you talking to your banks and, inquiring about capital availability if you do find the right asset to buy?
I think we are doing some small refinancing work as we speak. Nothing dramatic in terms of changing our debt profile, but we are going to consolidate 2 loans with 1 bank. We're working on this. That could possibly release 4 or 5 million to use for either an acquisition, or perhaps we can pay down some of our preferred to reduce our interest and dividend costs. So we're going to do a little bit of work on the refinancing, but more cleaning up, I should say, and consolidation of loans rather than anything major at this point.
Okay. And then, when you're looking at potential acquisitions, Tasos, I heard you loud and clear about your stance on scrubbers, that you didn't think it was, economic or the right thing to do at the time. When you're looking at an acquisition, does your scrubber view preclude acquiring assets with scrubbers? Talking to other companies, my sense is that the scrubber installations actually are not getting fully recovered when asset sales happen. So I was just wondering sort of if you can give a flavor for, does it matter whether you acquire a scrubbed or non-scrubbed vessel?
I think our technical department has developed a view that certain scrubber installations are not attractive. So we would perhaps rather get a no-scrubber ship and rely on using more expensive and low sulfur fuel than getting any scrubber installation. I understand certain other scrubber installations might be more appropriate, but frankly, my personal opinion, and I'm not part of the technical department to give a qualified opinion, but I would prefer perhaps not to have a scrubber if that gives you a little more flexibility. I think it doesn't bind you on a way. If you have to pay extra for the scrubber, I would prefer probably not to have a scrubber.
Yeah, and one thing that I've been asked about and asked to other companies is just that, in the dry bulk sector, I mean, thermal coal is, an issue, maybe potentially going longer term, that it might be in secular long-term, decline. Is that something you agree with? Is it manageable? And sort of how does that factor into, your overall view on dry bulk demand going forward?
Yes, definitely. This is a trend that I didn't mention it during my remarks, that is out there. The coal, especially the thermal coal, is in a long-term decline over the next 10 years or so. I think this is the commodity that is the most affected by the emission requirements in general, and the environmental concerns, the climate concerns. Funny enough, in the near term, that might create opposite effects for shipping. For example, China might want to eliminate or reduce its low quality domestically produced coal and import higher quality from abroad. So in the near term, it might work. And actually, last year, I believe it worked the other way around. That long-term trend created some short-term positive effects for shipping. But I do agree that long-term, we're on a downward sloping trend for the coal trade. And that, I think, would be accommodated by accordingly adjusting the fleet supply. I think we are in a position right now, unique position, to be able to absorb that decline by not over-ordering again. I mean, there are other reasons not to over-order, but definitely, I mean, you can have a good market even with a declining trend for a commodity if you manage, if the ordering somehow takes into account that. It's very difficult in shipping for owners to work in a way that coordinate that, but I think it's manageable.
And then when you're scrapping assumptions, what do you think will be the catalyst for scrapping over the near term?
I think there are, I mean, judging from ourselves, when a ship is approaching a major capital expenditure, you always make the cost-benefit analysis whether it is worth making that expenditure or not. Typically, these decisions are around the dry docking that you have to do during special surveys. I think if a ship requires a lot of work to be done and a lot of cost to be expended during a dry docking, upcoming dry docking, and requires a lot of steel replacement, and the market prospects are not at the level that would justify making an investment, it is very likely that the owner will decide to scrap the ship sort of irrespective of age. So if we are seeing a healthy market over the next couple of years, the reasons to scrap a ship will be, of course, much fewer, and scrapping will be a little lower than otherwise.
But conversely, also, you know, potentially higher scrap prices might help too, a little bit offset that disincentive to scrap.
Yeah, it might help. I think traditionally, you typically scrap a ship because you don't think it will earn its cost going forward, rather because you want to take advantage of a high scrap price. I mean, a higher scrap price helps a bit, I guess, to make that decision. It helps at the margin, but I don't think it's the driver. At least I don't think it's the driver in our case to decide to scrap a ship because the scrap price is good.
Great, Tasos. I think we'll wrap it up there. I want to compliment you on a very comprehensive presentation, not only from a micro standpoint and talking about EuroDry, but also from a macro standpoint. Thank you very much for participating in NobleCon17, and have a great day, Tasos.
Thank you very much, Paul, and thanks everybody for attending. Thanks, Noble, for organizing the conference.